Well, the biggest news that we have seen from the US Fed in recent months is that they've started cutting interest rates for the first time since 2020. We all remember what was happening then. And for bond investors, this could be a shift that a lot of people have been waiting for. You may remember we've seen a pretty long period of painful losses here for fixed income, but there is finally some growing optimism that bonds might be ready to stage a comeback. I want to have a look in the video today at what this rate cut means for bonds and whether now it might be the time to make a move into the bond market. I would also like to say thank you for Harvest ETFs for supporting this video. I want to be sharing some thoughts on one of their funds. It's HPYT a little bit later in this video. First, though, let's look at what happened. In September, the Federal Reserve cut its benchmark rate by 0.5%. So that's half a percentage point. The goal there is to stimulate the economy. We're seeing inflation going down now. We're also seeing signs of growth slowing. I want to be very, very clear here. The shift in policy is significant. With that 10-year Treasury yield currently around 4.3%, and rates are expected to trend lower. I'm going to look at those rate projections in just a minute here. These conditions are very beneficial for bond prices. In the simplest of terms here, when interest rates go down, bond values will typically go up. If you look at their existing yields, they become more attractive relative to the new lower yielding bonds. For bond investors, this Fed rate cut does bring several potential benefits. Immediate long-term bonds, for example, they tend to perform well when rates are falling. They're more sensitive to rate changes than the shorter-term bonds are. Also, and I see this as a relief, this rate is also likely, hopefully, going to restore bonds to their more traditional role as a stabilizer in diversified portfolios. And over the past couple of years, we've seen bonds lose this role as they've suffered along with stocks from the rising rates. So now the Fed has started this easing cycle. Bonds might, again, provide that steadying force, especially if we see any sustained volatility in the stock market. It is worth noting here that while this rate cut environment generally will benefit bonds, it doesn't come without any risks at all. If we see inflation surprises or economic shocks, that could still disrupt the bond market. The upside here is that with yields at the levels that they're at right now, bond investors kind of have a cushion that can provide a little bit of resilience, even if we see unpredictable economic environments ahead of us here. So what's next here? Well, analysts are believing that further rate cuts are likely that could continue supporting bond prices into next year. As of the date I'm filming this video, the current target rate at the Fed is 4.75 to 5%. Now, the probability of a further cut when the Fed meets on November the 7th is sitting at 98.4%. Then if we look out into December, we're going to see that the market is expecting a 70.7% chance that the range will be 4.25 to 4.5 by the end of the year. If we then look out into January, the markets are betting right now that we're going to see rates at 4% to 4.25. At least 46.8% of the market is betting on that. So these are pretty good odds, I would say. What I'm advocating for here is a balanced bond strategy with a mix short, intermediate, long-term bonds, and especially long-term bonds. That's what I'm looking at most closely here. You might want to lock in today's higher yields while preparing for the potential of price appreciation if we see those rates move lower as anticipated. So with all of this in mind, I recently chatted with Mike Dragosits. He is the CFA charter holder and portfolio manager at Harvest ETFs. And I asked Mike to share his thoughts on what is going on in the bond market right now. And he offered some great clues as to what we might expect going forward. I'd like to share some of that interview with you now. The first thing I want to kick things off with is this. Given the economic situation that we're in today, when the US Fed cut rates last time, they opted for a 50 basis point cut, which was, a lot of people were debating whether it would be 25 or 50. They went a little bit more aggressive. This happened back in September. So as a fund manager, so, what were your thoughts on that, or what are your commentary on the more aggressive cut that they implemented?
Yeah, I think for us, it really just it signaled the Fed's confidence in their understanding of how the economy was slowing and the inflation story was slowing as well. So I think it was more of a confidence thing for them. We have to remember we saw probably one of the most aggressive rate rising campaigns, going back in history, and overnight rates came up, 5.5% to 5.5%, and that's probably the highest that we've seen in decades. And so
Mhm.
and again, that's much higher than where long-term bond yields were, which is roughly about 4.25 to 4.75 at the time. And so we had a highly inverted yield curve prior to the rate cut, and it is still, flirting with that inversion territory.
Mhm.
And that inversion lasted for quite some time. So I think what their intention was to drive the yield curve to this inversion, and it worked. It slowed down the economy, and we were getting things back on track, and that gave them confidence to kind of start off with a 50 basis point cut right out of the gate. And it wasn't really an emergency cut for them. It was just sort of getting the ball rolling towards starting the rate cutting cycle. And I think that's why they went 50 originally.
I like you used the word emergency, and yeah, leading up to it, we're hearing a lot of people, a lot of commentary saying that it should be, even a more dramatic cut than that. But I'm kind of happy with where they picked that spot there. An interesting thing. This is kind of what I was alluding to a minute ago. Interesting thing that I noticed is when the rate cuts, you're usually going to it'll have an effect on the bonds. Now this time when they cut the rates, the bond prices moved lower on the longer term bonds, and that's not necessarily what everybody would have expected. What are your thoughts on that? Why did that happen?
Yeah, and I think that's extremely important. It kind of depends on which bonds we're looking at. So the Fed cut the overnight interest rate, and so if you look at 1 month or 3 month bonds, like those prices, 1 year bonds, those prices did pop up a little bit here. And you're right, the long term bonds, they actually declined. The bond prices
Mm,
declined where their yields actually rose. And I think it kind of has to be taken into kind of the context of what was happening coming into that rate cut. I mean, this was a pretty well telegraphed cut. You can argue the 25 or 50 basis point, but we were talking about the start of a rate cutting cycle. And so, um, you know, long-term bonds had come down already over 100 basis points on the 10-year, prior to
right.
the first rate cut. So we had already seen bond prices come up quite a bit. And, there was a lot more confidence in the economy, the soft landing narrative. It seemed like Jerome Powell and the Fed members were a lot more confident in that. And so there was some changing of expectations, I think, around the worries about maybe a harder landing, yields coming down, towards maybe this narrative of higher for longer narrative. And so we saw those expectations change, and we saw that in the yield curve as well. Kind of what's happened over the past week or two. We've seen additional economic data come out. Most importantly, the employment data came out, and that was quite a bit stronger. Inflation data,
Yeah.
stopped declining as well. And so we've gone back to this idea that maybe the economy is not so bad. We're going to get that softer landing, and the market is starting to price that in as well. And you sprinkle in a little bit of the election worries, and that's boosted yields up a little bit. And so that's what we've seen over the past week or two is yields have really kind of jumped up, and bond prices I think have come down to
Mhm,
sort of
mhm.
price that in. You look at expectations for where the Fed funds rate was expected to go, was expected to drop down to 3% in this rate cutting cycle, and we're probably closer to about 3.75% is what the market is pricing in today. So I think that's kind of really what has driven bond prices down is that shifting narrative in the yield
Well,
market.
yeah, and I guess you can confirm or deny this, but but my understanding is that the when you look out to the longer term market, there's a lot of anticipation in those markets. They don't necessarily react to something that happened today. They're anticipating what's going to be happening, and so like I think what you just said was that was baked in already when the cut came.
Yeah, that's exactly right. I mean,
Yeah.
when we're talking about 10-year, 30-year bonds, there's a lot can happen between today and 30 years out from now. So they factor in not you kind of have to separate the short term yields from the long term yields because the long term yields have to price in economic cycles, inflation expectations,
Yeah.
political risks, things of that nature, and so they move
With
differently.
30 years, it kind of seems like a US election cycle. I know it's not that long, but it sure seems, it feels like that sometimes. You mentioned the landing, soft landing, hard landing. In the environment that we're in right now, what do you think? What do you see, if anything, that could change the environment? And or do you have any thoughts on how we're going to come out of this? Are they managing this properly?
Yeah, I think you kind of have two different scenarios, and there's no bell that will ring to tell us which one we're in. I think the market is really looking towards a soft landing outcome, and I think
Mm,
that's probably if you look at some of the economic data, that's what we're looking at as well. Going back in history, it's rare for a rate hiking cycle to end in a soft landing, but it does happen in
mhm,
1995 and 1984 as well. If we look at the mid 90s, um, the economy continued to grow even with higher interest rates. So the short end of the curve under that soft landing scenario, it came down a little bit, and the long end of the bond yields kind of stayed where they are, moved up a little bit, and so the curve normalized, got out of that inverted territory, it maintained that normal curve just by interest rates changing slightly. And if we look at where we are today, even if we had that soft landing outcome, we're still quite towards an inverted yield curve if you look at the Fed funds overnight rate versus sort of the 10, 20, and 30-year bonds. So there is still some expectation for those short-term rates to come down. Now, with 10 and 30-year bond yields where they are at 4.2% yield or 4.5% yield on the 30-year, maybe those don't have to change a lot from here already. A lot of it has already been baked in, as you mentioned. I think the big change for the bond market would be if we had sort of more of a hard landing, deep recession type of environment. In that environment, you could easily see the Fed cutting rates back down to zero pretty
Exactly.
quickly, and that will have knock-on effects going out the yield curve, and we would expect that probably bond yields would come down as inflation expectations are lowered and economic growth forecasts come down as well. And so that's kind of where I would see sort of the big changes in the bond market. But in a soft landing scenario, more of a maybe just an adjustment on the short end without the long end moving too much.
Awesome, Mike. Yeah, I just had those questions for you. I wanted to sort of keep things pretty tight here today and just answer some of those questions that I know, well, on my mind and on the mind of some of our viewers. So once again, I know you're at the office today. You're probably out managing portfolios as we speak. So I really appreciate you taking a few minutes and coming over and chatting with me.
Yeah, great. Thanks for having me, Mark.
You bet. Okay, so that's a lot of information that Mike shared with us. The question that I take away is, where do we go from here? And I think that for investors seeking stability, income, potential capital growth, and I do certainly count myself into this group, long-term fixed income right now, it does align with both current economic conditions and my financial goals, my longer-term financial goals. I think the conditions that we're seeing right now, in fact, are really representing a rare opportunity. For those of you who watch our channel here on a regular basis, you'll know that I've been saying that for a number of months now. This opportunity to balance the income with growth in a responsible manner. So yes, long-term bonds, of course, do carry some risks, and especially they are sensitive to inflation and to rate increases. But like I say, with the current environment, I think we have at least stable, more likely potentially declining rates, while some of these concerns are mitigated. I see this environment being attractive for two groups in particular. First off, if you are a risk adverse or income focused investor. So I think of people like retirees, near retirees, who often look to bonds for reliable income without the volatility that comes with equities. Also, the second group here is strategic investors who are expecting these rates to decline. So if you have a long-term outlook and if you agree that we're going to see this continued downward trend in interest rates, then this might be an opportune time to lock in the higher yields we have now and to capture future price appreciation. I would like to take a few minutes and talk about one of the funds that are sponsor managers here. This is the Harvest Premium Yield Treasury ETF, HPYT, and it is an actively managed ETF that's designated to provide investors with monthly cash distributions by investing primarily in U.S. Treasury bond ETFs. And that's exactly what we're talking about here today. When we look at the holdings, the ETF focuses, like I say, on those treasuries. Now, the type of investors that these can be considered for would be those who are seeking exposure to that high quality U.S. Treasury bonds, like we've spoken about, people who want to maximize income through covered call options. We're going to talk about that in just a second here. If you're looking for medium or long-term investment with lower volatility compared to equities, for those who desire regular income distributions with a portfolio that is focused on fixed income, or for investors who want diversification in fixed income holdings, especially again in this environment of changing interest rates. This fund uses a covered call strategy on U.S. Treasury bond ETFs, and that allows it to generate higher income than traditional fixed income investments. So covered calls, that involves writing call options on the ETF holdings that will generate premiums, and that will boost income up there. With HPYT, the level of option writing will adjust based on market condition, market volatilities, and other factors. Now, the covered call strategy, it does provide additional income, which can help cushion returns during periods of bond price weakness, if we do in fact see those in the next while. Last point here is that this ETF is non-leveraged, so that means it doesn't borrow money as part of the portfolio. A couple of key details. The management fee on the fund is 0.45%. I think that's a reasonable fee to run this full covered call strategy. I know when I used to do that, it's a lot of work. That's not something I want to do today, so I'm happy to pay that fee. The distribution frequency is monthly, and the risk rating on this fund is low to medium. So like I say, I do believe that we are seeing this rare opportunity in the fixed income space right now. I have, in fact, taken a position in HPYT myself. So yeah, I think the conditions are there. Again, thank you to Harvest ETFs for supporting this video, and thank you for watching. We'll see you in the next video.